I wanted to talk about what's going on in the market. The Fed's raised interest rates one more time. Okay, we've got sound. All right, cool. The Fed's raised interest rates one more time today, and the market went wild, went crazy, and so it's important to understand, what does that mean to you? What does that mean for you? What do you need to do? Do you need to do anything with respect? So I want to walk through some of the things that may impact you, and then I want to give you some of the things that you should be looking at doing moving forward with respect to your investments, your financial world, and all of that. Because it's important that we navigate these things and do not let them get to us, and to understand the perspective of it. So if you're coming in and you're typing in, do me a favor, pop your name in, because if you haven't done so already, I am using Restream, and so it doesn't if you don't give permission for Restream to display your name, you come up as Facebook user, and we don't like that. I want you to, or YouTube user or something. I want to know your name so we can call you out, and not call you out, but recognize you. Let's just put it that way. So let's just talk about what I've got some notes here I want to make sure that I hit on. And so let's talk about that, and then we'll talk about the market, which just closed just this minute. So we'll see what the market did. I'm going to break it down for you and get you to see where that goes. The first thing is this. The Fed raised interest rates at what they call 50 basis points, 0.5%, 0.5%, which actually is the highest increase since 2000, in over 2 decades. It's the highest increase since 2000. Their idea is that what they're trying to do is stem the tide of inflation, to slow that down. Price increases and everything. Inflation has been at 8.5%, was the last measure based on CPI, GDP, and CPI. So it's at 8.5%. And to give you perspective, the decade before the pandemic, the average rate was below 1.4%. So if you look at that, the rate of inflation has gone up sixfold. Okay, so it's a lot. What the Fed is planning on doing is, what they announced today is that they did a 0.5% increase. They anticipate up to more 0.5% increases. They say that it's still on the table, 50 basis point increases for the rest of the year. They probably want to get to about 2.5% to 3% by the end of the year. They were sitting at 0. Now they're about 7.75 to 1.25, somewhere in that range. There was some talk that they might go more aggressive to try and just really halt the inflation pretty quickly to a 0.75, but Powell pretty much poured cold water on that. So I don't know that that's the case. The market has priced in a 500,000 or a 0.5 point increase, and you're going to see why, because I'm going to bring the chart up so you can see it. They're hoping that through this process, we can get a message out to the world, to society, to say inflation is here. And it truly is. But it's not going to persist. It's not going to continue for long term. That's their belief. Their anticipation is that their process of increasing interest rates and reducing their balance sheet, in other words, buying back, reducing the balance sheet, will stem the tide of inflation in short order. Here's the challenge, and this is my concern. I don't think they completely know what they're doing. There's no science to it. They're anticipating what he said, and these are the words he said, which worries me, a softish landing. Okay, the ish worries me, okay? Are we ish on the hard side? Are we ish on the soft side? I don't know. And the historical facts are, every time the Fed has done this, and I'll explain what I mean by softish landing, every time the Fed has done this since World War II, we have pushed ourselves into a downturn. We've pushed ourselves into some sort of a recession. So my concern is that the Feds are saying it's softish, but they don't have a scientific mechanism that is proven. They're basically trial and error, and we could find ourselves in some sort of recession. We could find ourselves, in a situation like that we don't expect. We could be in a bear market type of thing. We're in correction territory, except for today, kind of reverse that. So here's the thing. There is the other concern that they brought up is this idea of what happened in the 70s. So I'm going to draw this out for you. So I'm going to go to my iPad for a second. And in the 70s, one of the things that happened was a wage price spiral. So what happened is because of the demand and everything, wages started to go up. And then because wages, people were making more, they were buying more. Started to go up. And when they're buying more, demand, when demand is higher than supply, what happens? Prices go up. When prices go up, the pressure to raise wages goes up. So this is the spiral they're talking about, is that wages go up, buying goes up, demand goes up, prices go up, wages go up, and now you have this spiral. Now the Fed is saying we're not in the same situation as we were in the 1970s, and therefore we shouldn't have that issue. Okay, let me show you something. I want you to see the chart of the market for a moment. Then I'm going to give you 7 things I think you need to do to keep yourself sane, safe, and out of trouble. And then I'll open it up for questions if there are any questions. I see some dear friends, Chris and Aaron, on here too. But let me just go to the market for a moment, okay? Now, the market just closed, but you can see on this chart, you can see that when the Fed made the announcement, the market just went crazy up, okay? Now, the market at one point was over 1,000 points up, okay? It closed, if you look at this, I'm going to refresh it so we have the most current, okay? So it closed at 932 points up. You can see that in the upper left corner here. But this uptrend that you see, these are increments, these are intraday kind of what happened. So you can see what was going on is when the market opened, it was just flat. It was going along. It wasn't doing anything. It was waiting for Powell to talk. And as soon as Powell talked, it started to drop in anticipation, and then it took off when it was a half point, and he said that the 0.75 is off the table. Okay. What we don't know is how many more increases we might have, but he did say that 0.5% is on the table. Now you'll see that it then flattened out at the end of the day and just kind of gave back a little bit. Okay. Why is that important? I think that we need to understand this from the perspective of the whole market. If I go in and just look at a 1-month chart and start to see this, and that's a 1 minute. Let's go to, let's go here. Let's take this. So I have that. So you'll see that this is a 3-month. This is basically from January 31st to now. You'll see that we're actually if you were to draw a line here, up, okay, we're almost in a channel. Okay, I'm going to zoom out just a little more. Six months. Okay, now you get a better look at what the market is doing. And we had this big uptick in this last day here, but we're still down from our highs, okay, which we're back here, okay, and you have high volume. So point being is this: bottom line is the market is volatile. The market's going to continue to be volatile. That means that If you're looking at your investments every day, you either like abuse, like the thrill, um, or I don't know. So here's the couple things I want you to consider is this. When we talk about getting into investing, the first thing that you need to understand, the first thing that you need to do is take a long-term view. Okay. If the market goes up 1,000 points, 900 points, and goes down 600 points, like it did last week, they're offsetting. But what happens is that when the market goes down so much, people freak. People go to fear faster than they go to greed, and fear and greed drive the market. When you allow your emotions to get involved. And if you've watched me or listened to me for any length of time, you know that when your emotions go up, your financial intellect goes down. So the tendency is to allow our emotions to enter in when we have these big swings in the marketplace. And when those emotions get into play, we start to make bad financial decisions. We make them out of emotions. We make them out of panic. We make them out of greed. And typically those don't work out well for us, okay? And so it becomes important for us to look at things through a long-term lens. When we look at our business or our finances, if you need your money, if the money that you have invested is something you're going to need in the next, 1 year, 2 years, 3 years, even 5 years, I'm going to tell you that you need to park it on the side. Because what could happen is that you're going along and the market is going to be doing this. The market's going to be doing this, and the question that you're trying to bet on is when you need the money. You're hoping that you need the money at the peaks. But what happens if you ultimately need the money and it happens to be down here? So I don't want to expose my cash to that kind of volatility. And so if I need the money in let's say less than 5 years, I'm going to put it in a high yield cash account. I get it. Inflation is going to eat the purchasing power, and some troll is going to come on this and go, he's telling you not to do it and you're going to get eaten up by inflation. I get it. But I'd be better off dealing with that for the short term if I know I need the money for a down payment on a house, for retirement, for something that I need in short term than be eaten up by the stress of not having it. Okay? And so that's the first thing, to realize that in the long term, if you take a long-term view, you're going to segment your portfolio. Now, in the long term, if I look at this, the market historically will do this. And historically, what you're seeing is that the market is going up. In fact, there isn't a 10-year period in which the market has gone down if we just take 10-year chunks. But if you look at this, you've got ups, you've got downs along the way. You got ups and downs along the way. So that's why we need to take a long-term view. Over the long term, market goes up. So I want to be a long-term view in that process. And then the second thing, so first is long-term view. Second, I want you to look at it as an investor. There's a difference between an investor and a trader. Now, I do trading and I do investing, okay? What I'm talking about is investing. That's a long-term view, okay? When we're trading, you're trading the peaks and valleys in short-term increments. That's more of a job, and it's a different game, and I'm not talking about that. It's a whole different conversation. I do trading, I do investing. I do both, but I come at it in a different way. So I want you to have an investor's mindset. Number 3, I want you to focus on liquidity. I want you to make sure that you have liquidity to sustain yourself should the Feds push us into a recession or a downturn or a correction or a bear market. I do not want you depending on your investments to continually go up in the short term. So I want you to have the liquidity. If you haven't done so already, I'll hook up the link, but I had an episode called "What Do You Do with Your Cash?" That is on my YouTube channel. You can go through it. It walks through where I want you to allocate your cash and how to do it first to keep yourself safe. Part of that is to have a peace of mind fund, to make sure that you have enough liquidity to sustain you through any kind of craziness and downturn, especially if you're an entrepreneur, because entrepreneurs can be affected even more so than employees because of the fact that you're trying to sustain the business and yourself at the same time. Hopefully this is making sense to you. If it is, let me know. So that's liquidity, which means that if I'm focused on liquidity, there's two elements that I want you to focus on. One is income scaling. What can you do right now, this week, to start scaling your income? Is it increasing prices? Is it asking for a raise? Is it a side hustle or another job? What can you do to scale your income so you can use that to build liquidity or move into the market if you don't need the money in the short term? Okay, so income scaling it's important. In the Affluence Blueprint, we talk about 8 revenue scaling methodologies in doing that. But the second component, there's 2 sides of this coin: income scaling, increasing your income, and expense trimming. I want you to look at your expenses. Now's the time to, let's say, get skinny again. All right. We want to get rid of the fat. If we're not using things, subscriptions or regular charges or things that we just don't need, it's time to get rid of them. It's time to get rid of them so you have enough margin for error, margin for volatility in your financial world. Okay. So I want you to look at income scaling. I want you to look at expense trimming to help facilitate that as you go forward. Then two last things on this. I want you to consider, to make sure that you stay in the game. I remember, we're going back to the 80s when I had some investments and things were starting to go south and everything. And I happened to be at a seminar. I listened to this guy that gave a doomsday report. And I literally walked out of the seminar, got into the hall, called my advisor and saying, sell everything, go to cash. Okay. What was that speaking? That was my emotion speaking. Okay. Bad decision. Not only was it my emotion speaking, but it put the fear into me, and I didn't get back into the market. And what happened is I locked in losses and I left the gains that I could have received off the table. I want you to stay in the game. If you have the liquidity, if you're building the income, if you're trimming your expenses, you have all those things, you're following the wealth priority ladder and what to do with your cash, stay in the game. And the last piece, I want you to diversify. So if anything has shown us something, I don't know if I can pull it up. Let me see if I can pull it up. But if you look at, for instance, let's see if I can pull up Facebook. Okay. Meta platforms. Look what happened. You see this little gap here? Okay. See this this piece here, right here? Whoops. Let's go back to 6 months. You see that? This hole right here. It just dropped. Let's look at Netflix. Oh, look at that. You had a drop here and a drop here, okay? And if I look at this, you got that drop and then you have that drop. Netflix lost, look at where it was. Netflix at one point was way up here and now it's way down here, okay? At $200. It dropped 70%. Okay? Let's look at Hulu. Where is it? Hulu. It's not in here. Ba. All right, well, it looks the same. There's plenty of these examples. Here's why this is important for you to think about. When you don't diversify and you say, I'm going to buy, Facebook, if all you had was Facebook and you had that drop, you got hammered. If all you had was Netflix, you got hammered. If all you had was tech, you got hammered this month. April was one of the worst months for tech out there. Diversification will reduce the impact and the exposure to your portfolio. Now, so it's important for you to come at it with a solid strategy, a solid portfolio that has diversification with a long-term view, with an investor view, and you'll be okay. I don't want the media, the financial media, the social media, and all the people out there that are trying to fan the flames of fear to freak you out. I don't want them to stir up the emotions so you make emotional decisions. Rather, I'd want you to think about things and make logical, informed decisions. It's the reason I have my show, the Affluent Entrepreneur Show. It's the reason I do these things. And it's the reason that I'll answer your questions if and when they come up. And you post them and you let me know so we can jump in, do it live, do it on an episode, do something, bring you on, coach you, whatever it takes to make that happen. So I just wanted to jump in to spend a little time to talk about, the fact that one, Fed's raised rates. What does it mean to you? Two, market went up almost 1,000 points. What does it mean to you? Look, it went down 600, 700, 900 last week. So it is what it is. All right. But I wanted to give you those 6 things I think that you need to do will sustain you for the long term. All right. In the meantime, if you have questions, if anything comes up, do me a favor, post it, send me a note, send me a DM. Let's keep you moving forward. All right. And let's keep you safe because financial freedom is your birthright. And I want to give you the path to claim it. I got nothing to sell to you as far as investments, insurance, or any of that stuff. I don't have those licenses. I simply want to invest. I want to sell you on your dreams, and that dream of having financial freedom, which I think is not a dream. I think it's a right. We just got to give you the pathway to claim it. All right. I hope this helps you. And in the meantime, until I see you on another live, another episode, another show, always live a life that outlives you. All right. Cheers. Okay. I'm going to stay on a little bit. If anyone's got any questions, I'll make sure that you post them and I'll make sure that I answer them. If not, I will sign off. I will bid you adieu, and I hope that you have an incredible, incredible Wednesday. Cool. All right, no questions coming in. So what I'm going to do is I'm going to sign off. But if questions come up, do me a favor, send me a note, post a comment, and let's keep you moving forward. Blessings to you. Cheers.